Hello and welcome to Move or Improve with Debbie. I'm Debbie Miller, your host. Today I'm going to discuss a topic that may be one you're sure you know about and you have a negative opinion. So stay with me through it because I have asked Laurie MacNaughton to join me today to talk about kicking the tires on reverse mortgages. Now, Laurie is in the top 1% of reverse mortgage originators nationwide. And she specializes in both FHA and proprietary reverse mortgages. And she serves as a reverse mortgage specialist with the goal of making retirement the best season of your life. And so thank you so much for joining me today, Laurie. I really appreciate it. And I think we're going to get some good discussion going. Welcome.
Well, thanks for having me.
So let's get right down to business. First of all, explain to listeners what a reverse mortgage is.
Sure. A reverse mortgage is a home equity line of credit. And I always like to tell people I could pretty much leave it there and you would know more than most people. A reverse mortgage is a home equity line of credit, much like any other, but it has some really nifty features that are specifically designed for the retirement years. And I like to review the name. What we all grew up with is called a forward mortgage, and the name is derived from the direction of repayment. Every month you pay it forward. A reverse mortgage, on the other hand, is repaid on the back end in reverse, hence the name. So it's repaid when you no longer need the home, either because you sell the home, because the homeowner has passed away, or the homeowner has transitioned into other housing.
Well, that's a very good way to talk about it, but who is eligible for a reverse mortgage?
To be eligible, at least one person, one title holder, has to be 62 years of age, and they have to live in the property as their primary residence, which is defined by 6 months of the year.
Oh, okay. So at least 6 months. Okay, great. So what is the process for applying for a reverse mortgage versus the traditional mortgage that we know about?
The process is much like any other loan someone would be familiar with one specific requirement. So basically, somebody gives me a call or gives a reverse mortgage specialist a call, says they would like to start the process, and then they gather their documents, very routine documents, and then you can either apply when the loan officer sends the homeowner a link, or you meet face-to-face with them and fill out a paper application. A lot of my clients are still preferring paper applications just so they can, it's just something they're more familiar with. And sure. The one special requirement is the homeowners must meet with a phone counselor or a face-to-face counselor. Right now during the pandemic, face-to-face counselors are not very common, but the counselor is screening for comprehension. They're screening for coercion. Is somebody twisting the homeowner's arm to do this, to do a big equity grab? And then they're looking for questions. So the phone counselor walks them through the basic numbers, the concept, and then during the course of the conversation will not diagnose nor determine, but screen for comprehension.
Well, that makes good sense, yeah. So how do they figure out how much the amount is that they can use, and what about the interest rate?
Great question. So interest rates, of course, we'll address in a second, actually, but interest rates vary with prevailing rates. To qualify, or the loan to value is your basic question. How much is the loan to value? The minimum equity someone needs is 50% equity. And right at 62, someone is going to qualify at today's rate for about half the equity in their home. So if they still owe, Main Street Bank, some lender, 50% of the value of their home, is what happens is we buy out that debt. We refinance that debt into a reverse mortgage. And in that particular case, nothing happens other than their monthly mortgage payment goes away. However, if that exact same person at 62 has a paid off home, they're going to qualify still for that 50% of the equity. But now that equity goes into a home equity line of credit for them. So the more equity you have, the more can go into a line of credit. And the older you are, which is kind of counterintuitive, but the older you are, the higher your line of credit is or your loan to value is. So if somebody is in their mid to late 70s, they're going to qualify for a lot more than somebody who's in their early 60s. The loan to value maxes out when somebody hits their late 70s. Interest rates.
Go ahead.
Interest rates vary as the market varies. There is a fixed rate. It's not commonly used anymore, but you can do a fixed rate reverse mortgage, and the rate on that's in the upper 4s. And then there are adjustable rates, and those are in the upper 2s. And sometimes, depending on what prevailing rates, they're in the lower 3s.
So do they, when you say the appraised value, how do they do the appraisal of the home? Do they do a drive-by? How do they figure out what the house is worth? Is it obviously based on any improvements? And if it hasn't been improved, obviously it would be a lower value. Talk a little bit about how that appraisal process works.
Sure. Great question. I get this question a lot. Right now, because of extreme circumstances, nobody wants to be in somebody else's home. Homeowners don't want some stranger in their home. So they are doing drive-by appraisals, and then they do a lot of work with market comparables. So very much like any other appraisal, they have to come up with comparables. And then the homeowners are forwarding interior pictures to the appraiser. So the appraiser has an idea of what kind of home improvements have been done, what kind of updates. And values run exactly as you would expect, based on comparables. So we don't see appraisers taking any kind of great discounts or anything else just because, they're not inside the home. They're very much market value appraisals.
Well, that's good to know because, this is for many people, it's going to be a new thing to go through this. And the more information they can have, certainly the more comfortable they'll feel about the process. But so once they get through all of this, how do they set up the money that they would get? Is it like a lump sum or a line of credit to use when they need it? Or how do they decide what they want? Or is it not a decision, it's already set up? Great question. So I'm going to actually use some hard figures here so that we're dealing with maybe a more vivid word picture. But we're going to make, just arbitrarily, we're going to make the homeowner 65 years of age, which is a little older than the minimum of 62. So 65, married couple. And for argument's sake, let's say they're in a $300,000 home. Because of the age, they're going to qualify for about 50% of the equity. And for argument's sake, we're going to say their home is completely paid off. So their line of credit is going to hold about $150,000. The way the feds have the parameters of this set up, in year one, they have access, the married couple has access to 60% of what they qualified for. And day one of year two, the other 40% become available. So if the couple has a cash need in year one, they can take the full amount available in a lump sum, if they so desire, or they can take, let's say they only need $30,000. They want to do an upgrade to a bathroom. So they take a lump sum of $30,000 at closing, and then the rest of the line of credit just sits there. And I compare it to a lump of bread dough. As they need cash, they nip off of it, use that. And the reason I like to compare the line of credit to a lump of bread dough is the reverse mortgage line of credit does something no other line of credit does, which is it actually is growing over time. So their available credit is actually growing over time, much the way a lump of bread dough sitting on the counter gets bigger over time. They nip off of it, and whatever's left in the line of credit continues to grow. And then, as I mentioned, day one of year two, the 40% held in reserve they couldn't access in year one then becomes available, and it will have grown over time as well. Well, that's a good analogy. I like the snipping off the piece of dough. That's a good way to think about it. That makes it much clearer. So talk about how much does it cost to get a reverse mortgage? What are their closing costs? I mean, how does this all work?
Sure. There are 4 closing costs allowable by law. One of them is the mandatory mortgage insurance. This mortgage insurance goes, as I like to say, unto the smallest farthing to the FHA. It gets held in the general fund, and we'll talk about that more in a second. It plays absolutely a critical role in the safety of the reverse mortgage program. Number two is an origination fee. A portion of that pays the loan officer, and then the rest go to processing fees. Some people call them onboarding fees. The third are the title fees, and these are normal and customary fees you see with any other type of loan, and recordation and so forth, transfer taxes. And then the fourth that's allowable by law is a statement fee. My company just doesn't charge a statement fee, but it is allowable by law. I'm going to return to the mortgage insurance premium. The mortgage insurance premium does the following. If somebody originates a reverse mortgage, and let's say, we'll go back to the example of the 65-year-old couple, let's say they borrow $150,000 and they actually end up using all of that. And then something dire happens to the housing market, and now their home is only worth, I'll think of apocalyptic terms here. So now their home is only worth $20,000. With a traditional loan, the lender would tend to put a judgment against the estate. So when the estate is settled, the lender who held that loan is going to get repaid whatever is available. With a reverse mortgage, however, neither the homeowner nor the heirs nor the estate is on the hook for that shortfall, because the mortgage insurance covers whatever the sale of the home cannot. Were it not for that mortgage insurance premium, this could be scary. Potentially the state could be on the hook, and then under certain conditions, that debt would still be due. With a reverse mortgage, that never happens. So the costs of this are the so-called normal and customary costs, and there must also be that mortgage insurance that goes to the FHA.
And so what is that? Is that a percentage, or is it a flat fee? How do they figure that out?
Well, there's a big old formula they use. I won't go into it. It's a little bit tedious, but you should expect fees anywhere between about $9,000 all the way up to, depending on the home value, they can be $28,000. It's paid for out of the line of credit. So it's the first draw on the available funds. You don't write a check for that amount, but rather the first slice of the pie that you had available to you went to pay closing costs. There are two fees that are typically paid up front, though not always, and those are the counseling fees. We talked about the mandatory counseling session, and then in most cases the appraisal is paid for up front. But in situations of financial hardship, both of those can be paid for at closing as well.
So how much does it cost to take the counseling session? Does the government set the locations up, or do you do it on Zoom, or how do you do it?
Super great question. Most of the phone counselors are doing it, or most of the counselors are just doing phone calls. And anybody can be on that call, on that counseling call, except for the loan officer. They want to make sure that there is no undue influence by an interested party. So the loan officer cannot be on the call. Family members, pastors, priests, attorneys, accountants, I've had all of these join homeowners on their call, and next door neighbors even. And it typically costs anywhere between about $90 and $150. However, that cost is set, or the fee is set by the phone counselor, him or herself. And it's just, I believe that the federal code just simply says, it may even use the term normal and customary